Welcome to the deep dive. Today we're jumping straight into Nutanix's latest numbers, Q4, the full fiscal 25, and what they're projecting for fiscal 26. So the big question for you is, what's the real story behind these figures? Where are they actually heading?
Exactly. We need to look past just the headlines,
Yeah.
dig into the details and see what their strategy looks like based on these reports.
Okay, great. Let's kick off with the big picture then. Fiscal year 2025, it sounds like it was a pretty significant year for them. What really jumped out?
Well, yeah, looking at the top line, first full year revenue for FY25 hit $2.54 billion.
Okay.
That's up 18% year over year, which is quite strong. And maybe even more telling, their free cash flow, FCF, for the year, that jumped 26% to $750 million. So not just growing revenue, but generating, serious cash.
Right, 18% revenue growth and 26% FCF growth. That's a healthy combination.
Yeah.
What about the last quarter specifically, Q4? Did it finish strong?
It did, yeah. Q4 revenue was $653.3 million. That's a 19% increase compared to Q4 last year. And what's interesting is that number actually beat their own guidance. They were expecting something between $635 and $645 million.
Okay. So they outperformed expectations there. What about margins?
Yeah, their non-GAAP operating margin for Q4 also came in ahead of guidance at 18.3%. So it points to pretty good execution, really closing out the year efficiently.
Efficiency. That makes me think of the rule of 40.
Mm.
I know we talk about it sometimes. Can you quickly break that down again? And, well, how did Nutanix stack up?
Sure. So the rule of 40, it's basically a quick check for software companies, right? You add the revenue growth rate and the free cash flow margin.
Got it.
If the total is 40 or higher, it generally suggests a healthy balance between, growing the business and making money. For FY25, Nutanix scored 48.
48. Okay.
Yeah, and this is actually their second year in a row being above 40. So it shows pretty consistent performance, balancing that growth and profitability. It's a metric investors watch closely.
Right. So not just growth for growth's sake.
Yeah.
Okay, strong financials. Let's talk customers and recurring revenue. How's that side looking, their subscription model?
That's where ARR, annual recurring revenue, is key. It hit $2.22 billion in Q4 FY25, which is up 17% year over year. So that subscription engine is definitely humming. And customer acquisition was strong, too. They added over 2,700 new logos in FY25.
Wow, 2,700.
Yeah, that's actually their best year for new customer adds in 4 years, brings their total count up near 29,300.
So they're still bringing in a lot of new business then? What about how long those customers are sticking around, or at least committing for average contract duration?
Yeah, the average contract duration at ACD was 3.2 years for Q4.
Okay.
That's just a slight tick up from 3.1 years last year. So pretty stable on that front. And it's probably worth mentioning, they emphasize non-GAAP figures like ARR and FCF. They feel it gives a clearer view of the core business, stripping out things like stock-based comp. But they always point out these are supplemental to the official GAAP numbers. Oh, and a small technical point, they're tweaking how they calculate ARR starting next quarter, Q1 26, just to align it better with when licenses actually become available to customers. Just a reporting change, really.
Gotcha. Okay, so beyond just the core numbers, were there any, standout achievements, partnerships, things that really helped drive this performance?
Oh, absolutely. Product-wise, their Nutanix Kubernetes platform, NKP, got some really significant industry nods. Named a leader by Forrester in their Multicloud Container Platforms Wave, and a challenger in Gartner's Magic Quadrant for container management.
That's big validation, right?
Yeah.
Especially in the Kubernetes space.
Huge. It shows their tech is competitive in a really hot market segment. That directly impacts deals. And then on the partnership front, they really doubled down. Signed new or expanded deals with AWS, Pure Storage, NVIDIA, Google.
All the big names.
Pretty much. These aren't just paper partnerships. They're about deeper integration, reaching more customers. Think hybrid cloud with AWS, AI infrastructure with NVIDIA. Plus, they locked in a big long-term contract with Finance Informatic over in Europe. That's a major win.
Okay.
And one more thing showing confidence, the board approved adding another $350 million to their share buyback program. Signals they think the stock is a good value.
Right. So summing up FY25, strong growth, good cash flow, hitting that rule of 40, lots of new customers, key partnerships firing, and industry recognition. Seems like a solid foundation.
Yeah, definitely a positive scorecard overall.
Okay, so if that's the look back, let's pivot. What about the road ahead? Fiscal 2026 guidance. What are they telling us to expect?
All right, looking for Q1 fiscal 26, the first quarter, they're guiding revenue between $670 million and $680 million.
Okay.
And they're targeting a non-GAAP operating margin around 19.5% to 20.5% for the quarter.
And pulling back for the full year, fiscal 26. What's the target range there?
For the whole year, they're projecting revenue between $2.90 billion and $2.94 billion.
Mm-hmm.
Non-GAAP operating margin is expected to be between 21% and 22%, and free cash flow somewhere in the range of $790 million to $830 million.
Those numbers suggest continued growth, clearly. But, guidance is always built on assumptions.
Yeah.
What are the key factors behind these numbers? What's the context we need?
That's exactly the right question. It's not just the numbers, it's why those numbers.
Yeah.
So several things are baked in here. First, they still expect to add new customers, probably in the mid to high 3 digits each quarter, so continued acquisition.
Okay.
But they're also being cautious about the macro environment, things like uncertainty around U.S. federal spending, currency swings.
Yeah.
They're acknowledging those potential headwinds.
Right, the usual suspects in this climate.
Exactly. Second point is renewals. The total pool of contracts coming up for renewal will grow year over year, which is good, but the rate of that growth is expected to slow down a bit compared to FY25. That's pretty natural as the overall renewal base just gets bigger, the base effect.
Makes sense.
And related to that, they're assuming a slight dip in the average contract duration compared to FY25.
Oh, why is that?
Well, FY25 had some particularly large deals with longer terms. They're basically saying they don't expect quite the same concentration of those extra long deals in FY26. Maybe customers being a bit more cautious, opting for slightly shorter terms.
Interesting nuance. So, macro caution, moderating renewal growth rate, slightly shorter contracts.
Yeah.
Anything else influencing the outlook?
Mm-hmm.
New products? Partners?
Yeah, a couple of things. They always mention the timing of revenue recognition and cash collection, especially on big deals, can cause some lumpiness quarter to quarter. That's just enterprise software reality.
Sure.
On the positive side, though, they're starting to see contribution from newer solutions, like their platform supporting Dell PowerFlex. First deals closed in Q4. It's small now, but expected to grow. And they also expect partnerships like Cisco and Dell to contribute more significantly as those relationships mature.
Got it. So new growth avenues starting to kick in. What about the cost side? Operating expenses? Any shifts there we should be aware of?
Yes, definitely. They flagged about $25 million in extra operating expenses hitting FY26. This is mostly due to hiring that was planned for FY25 but got delayed, so those costs land in 26 now.
Ah, a catch-up on spending.
Sort of, yeah. And there's another headwind around $10 to $15 million. This comes from some non-recurring partner payments they received in the past, which offset R&D costs. Those payments are expected to taper off.
Meaning R&D costs will look a bit higher on paper.
Essentially, yes. It puts a bit of pressure on the reported operating expense line.
Okay, so it looks like the plan is continued growth, aiming for that $2.9 billion revenue mark, decent margins and cash flow. But they're definitely factoring in the wider economy, some natural shifts in renewals and contract lengths, and managing those specific expense headwinds.
That sums it up well. They seem to be aiming for steady, managed growth, balancing the ambition with a realistic view of the operating environment.
Fascinating how they're trying to navigate that balance between expansion and efficiency with all these moving pieces.
Well, that was a really insightful deep dive into Nutanix's numbers and their outlook. It's pretty clear they're steering through a complex market using product strength and those key partnerships.
Absolutely. You see that constant focus on the subscription model, but they're also very aware of the global economic factors and making those necessary operational tweaks. It's that modern enterprise balancing act, really.
So thinking about all this for you, the listener, you've got the strong customer adds, but maybe slightly shorter contracts. You've got innovation, but also those cost headwinds and macro worries. What's going to be the most critical thing to watch for Nutanix in fiscal 26 to see if their strategy is really working? Is it going to be maintaining that ARR growth, hitting the FCF targets despite the pressures, or maybe something else? Will that push into AI and cloud platforms with partners be enough to power through the uncertainty? Definitely something to keep an eye on as the tech landscape keeps shifting.